Okay, yeah, we should be fine. Okay, so. And I think you don't see me now, right? Great, okay. Okay, great. So, so today's topic, so first of all, like it's again to mention for some people who just joined, so this is Finance Meets Real Estate. We do weekly lectures every Tuesday. We have a YouTube channel. I put it on the chat. Make sure to subscribe there. I'm the lecturer this week. So a little bit about myself. So just one moment. I'm a former financial engineer. I used to manage a derivatives portfolio jointly with my colleagues. And I am a multifamily investor currently, as well as in the recent about 3 years. And I also speak on real estate analytics, like overvalued markets and data-driven investing. And I'm a managing partner at my investment firm, Propel Capital, as well as founder of NB Analytics, an investor-geared real estate analytics system. And I organized this webinar series as well. So today's topic, so this is our table of contents. So today we're going to talk about modeling apartment communities. So first of all, I just wanted to kind of open the discussion a little bit. Like if you guys want to put in the chat, maybe like how many of you actually know what we will be talking about today, what I'm talking about at all. Like I was actually curious because we had my colleague put sort of an announcement on Facebook, and there was actually like a good response, like a good interest. And then from that, I found it curious that people are expressing interest where I thought, is it even clear what is meant? You know, do they know what the topic is? I'm not sure. So if you guys want to put in like what your view is, like what are we talking about in terms of apartment communities? You know, let me know, or if you have like specific question on that. So yeah. So just an introduction. So again, the focus today is modeling apartment communities at scale in an automated fashion. So this is my own model for large apartment communities, which can be anything over 5 units, or more typically 50 or 100 units for people who are multifamily syndicators here. So anything that has where the valuation is subject to net operating income. And when I say modeling, so this is not kind of your typical, or you have like an income and expense sheet. This is your NOI, and that's you know, that's the value of the property, you know, which is, you know, maybe, you know, to some people is new, but to the more experienced operators is relatively obvious. It's more like, how do you do it at scale? You don't have income expense sheets, so essentially the problem at hand is you know, a lot of transactions in the large multifamily space get done off market. So essentially, and how do you analyze those? So you get fed a single income expense sheet for a single property, and you need to kind of analyze it and see, okay, does it have a favorable value add, you know, for you to execute your business plan? And what is the goal here is actually to scale this, even in a preliminary analysis sense, and have it in a scaled automated fashion across geographies, across different properties within the same geography, etc. So that's that. So as a result, some of the content of the presentation is technical and includes programming knowledge. You don't need to have it though. You can purchase vendor like apartment data, for example, or subscribe to like no-code scraping tools, or just use spreadsheets on top of that to analyze the data. But the goal again is not so much related to the data source. The goal is really showcasing the methodology. So you can use different data sources, you can use Reonomy, etc., whatever you want, but the idea is really to showcase, okay, one example of a model to do that. So yeah, so first, like some comments on the data and like some very important legal disclosures. So data can be sourced from online resources, in which case I very much urge you to, you know, use legal advice in terms of attorneys specializing in internet law, intellectual property, or online contractual obligations. So So that's one scenario in which we source the data in an automated fashion online. If you purchase it from vendors, again, it's not necessarily that you can reuse it in every way. So some of the analytics on top may be against sort of your contractual obligation with the particular vendor. So for any sort of intelligence work with data, I would, it's generally like make sure to consult on internet or, you know, like intellectual property attorney. So that's that. From there, like a technical introduction. So for this this analysis, I use Python. So for some of you who don't know, so Python is a programming language just like C++, JavaScript, Java, etc., and PHP. But it has very much grown in popularity in recent years. So here above, we have a chart from Stack Overflow. So Stack Overflow is kind of like, I guess what's like Q&A, sort of a Q&A forum for solving programming problems. So that's from Stack Overflow through the end of 2017, like the growth of Python in terms of question views, and in like high income countries only, like question views, Stack Overflow question views. So, you know, like it's one indicator, of course, it's kind of biased to their demographic. Like they do mention it's more in high income countries, so it's kind of countries like US, etc. But the usage grew enormously. And then in the bottom chart, we have actually a ranking from Spectrum, IE Spectrum, which is showing like Python is kind of is number one in their ranking in terms of popularity. And some of the reasons for that is the growth of machine learning and, you know, data analysis and sort of being able to do it more efficiently from a computational standpoint. So data science is one. It's also used for web development, and it's used for as a scripting language as PHP or others. But yeah, so there's Python has a solid claim to being the fastest growing major programming language. That's as of you know, that's end of 2017. Yeah, so from that, so anytime you want to use data, and again, this is a real estate lecture, but I just want to make kind of bring a new mindset to the table where you have loads of data that you can use in your analysis that is public online. To be able to use this data, you need to have some understanding of the internet technologies and languages. And so some of the main languages used to kind of build the internet code are, okay, HTML, obviously JavaScript, CSS, server-side languages, and then database languages. So, so you would have HTML would be like your main elements building blocks on the web, and then you would have JavaScript for dynamic content, CSS for styling, and you need something on the server side, etc. And that's, let's say, maybe beyond the topic of this discussion. But understanding of like the general framework without knowing those in detail, but knowing what they're for, like how are they present, etc., is very useful for data mining or data gathering online. So one of the ways for data gathering is, well, web scraping. So web scraping, again, like do make sure it can be permissible in some cases, and in many it's not. So do make sure to consult an internet attorney for that. The most used example of web scraping are search engines, obviously like Google. So crawling and scraping both. So kind of that's one example. To be able to have something like Google, you need that. Another example are like news, like RSS feeds, you know, also like company information, like social media interactions could involve that, etc. But this is just like some of the just an introduction where if you do want to be analytical as an investor, or if you want to be analytical as a marketing person, my personal view is you need to be knowledgeable of internet technologies and languages, and sort of be able to, you know, utilize data in this manner. So that's, you don't need to be obviously a coder. Most people don't like it. Most people are not comfortable with it. That's understandable, but you can have like kind of conceptual understanding. And yeah, so that's on the tech side. Then on the real estate side, so this topic is value add of apartment communities, right? Off-market apartment communities. So how are apartment communities valued? So commercial multifamily as well as other CRE are valued according to actually not just the income method, but several methods. So you have, okay, income capitalization method, sales comparison, cost approach, value per gross rent multiplier, value per door, and cost per rentable square foot. So many people at like multifamily investment presentations, they would say, okay, it's income approach. It's not necessarily the case. So I've been seeing this in my own investment at like small unit sizes, like 6 units, etc. It's generally a mixed approach where you have a comparables mixed with income. And like, this is just one example, but it's really sort of per unit. What is here described as value per door approach is used for large, like 100, 200 unit apartment communities as well. It's a supplementary method. So generally, you know, appraisers are not, I would say, silly, you know, or like they want to get like a good sense of what the building should be worth. But the predominant method is income capitalization approach. So that's, you get the net operating income of a property, where the net operating income is, okay, let's say your rental income adjusted for vacancy and let's say non-payments, and then some other income if you're collecting other fees, let's say like pet fees, etc. And you know, less your operating expenses, your taxes, you know, your taxes, insurance, maintenance expenses, etc. So that's your NOI, right? So this is kind of obvious. Okay, let's see. So this is what every you know, like most real estate lectures they have. Okay, you have NOI divided by well, your cap rate is your NOI divided by the market value of the property. So if you want to back out the market value of the property, you need to do the NOI over the cap rate, but the cap rate now is not, you know, obviously the property cap rate now is the market cap rate. So you need to use like an aggregate from the market, and then that's your value. Okay, so considering that commercial multifamily is valued this way, then how do you realize value out there? So as an investor, you want to buy something and you want to raise the value of the property, right? So that's part of the goal. Another goal is maybe you just want to realize the cap rate. So, and it's not really the cap rate, it's the spread of cap rate to interest rates, and lever that. So that's a good strategy. You can kind of get surplus cash flow in this way. But most investors are sort of looking for a deal, which I feel is always done incredibly well in the real estate space, where that concept exists, and you don't want to pay like kind of the market value for a property. Potentially you want to have some discount, but besides that, besides the discount, you want to be able to improve it and raise its value. In residential space, that's not so easily done. You need to because you need to like commit renovation costs, and then maybe it's going to be worth more than the expenses that you put towards renovation. In commercial multifamily, in theory, you could do it without renovation by just if you are able to raise the rents in as-is condition as well. So that's or with renovation, both ways. But bottom line, if you raise the NOI by X%, you raise the value of the property by the same X%. So that's what is very much the game in the commercial multifamily space, as many of you know. So that's but how do you model that though? Because you get fed like it's mostly off market data. You get fed a single property, like I mentioned at the beginning, and you need to analyze it, and you do it on a singular basis. So how do you do it with data on a more systematic and like large scale across markets? So first, like where is where commercial multifamily properties can be found, let's say. So one is on the market. They can be found on, you know, if they're listed, if they're on market, they can be found on listing services like WhoopNet and Crexi. And if they are off market, then, well, they're not there. Now you have the multitude of all apartment communities out there. And then there are vendors like Prospect Now, like Reonomy, etc., which you know, which may give you some data on those apartment communities, and you can use it to you know, you can use it to typically to send direct mail to the owners. I think that's mostly what is happening. So the goal of this lecture is, okay, besides the direct mail, let's have some analysis on top. So that is kind of the problem that I'm trying to solve. So yeah, so how do we scale the analysis process? So data sources. So to scale the analysis process for off-market apartment communities, we need first to get all the off-market data. So the off-market data comes from CoStar, Reonomy, RD Matrix, Prospect Now vendors, or with the advice of your legal counsel or like internet attorney, online resources. An example of an online resource is apartments.com, which is owned by CoStar. Again, like highly cautioning towards using that in a commercial setting. This is for informational educational purposes to showcase the model. So that's that. But if it's vendor purchase data, you would typically get, so here's an example, something like this. So this is the feed from Reonomy. It's like really hard to read. It's not about the actual contents, but this is a sample feed. Essentially, it's going to give you like multiple buildings with different unit sizes in a given market. And you typically are constrained to buying like several markets only, or like whichever account your subscription plan allows you to purchase. And you would have like the properties of these buildings, and you would have, let's say, the owner information, and you would, maybe like direct mail to the owner. So this is kind of the typical setting. But if you want to perform income expense analysis, now which are the best buildings here? Like I have no idea. Like there's no information to actually study the financials. So to study the financials, you need to go beyond that. You need to purchase rental listings data, or if you want to venture into like online public data, you could also use that in whichever ways is going to be most appropriate. So that's so here in this model example is showing doing the off-market financials data with apartments.com. So again, the approach is to derive insights into individual properties, income and expense using publicly available rental listings data. So if you have the rental listings data on apartment communities, you can infer different things that I'm going to mention on the next slide. So the largest public repository of rental listings data for big commercial multifamily is CoStar, is owned by CoStar naturally, and that's CoStar's apartments.com. Currently, there is little analysis of off-market multifamily financials done in a data-driven, scalable fashion. Individual income expense sheets are supplied to a purchaser operator and analyzed on a singular basis. So there is limited capacity to harness off-market data in terms of financials and to scale like for preliminary insights. So all your deep insights you're going to get on the singular basis afterwards either way, but for preliminary insights, there is not so much capacity by simply purchasing vendor-based data. It's not going to be enough. And so here methodology, like in terms of, so commercial listings data may serve to provide insights into income and expense. And now the benefit is if you have this data for like thousands and thousands of properties, you can kind of, okay, you don't have the income and expense of that exact apartment building, but you can get some glimpses of insight into it, and you can do it nevertheless now in a super scalable way. So some of the things that you can actually get glimpses into are rent levels and unit mix, other income such as one-time and recurring fees, including pet-related parking, storage, administrative, application fees, etc. Occupancy rates, utilities expenses like gas, water, electric, etc. So various utilities expenses that those buildings have. So this is all information that may be contained in rental listings data. How you obtain rental listings data is up to you. I'm not giving advice for that, besides showing kind of an educational model of like a single source in this case. So here is an example, like just some snips of rental listings data where, okay, we have a multifamily community called Midtown Commons. We're able to see the range of rents, then they have like all the breakdown, etc. So we're able to see like the unit mix with square feet and like number of bathrooms, etc. You're able to see the other fees of this property, if they're charging pet fees, administrative fees, etc. And you're also able to see how many units they have currently vacant, potentially, dependent on how they presented their data and what utilities are being billed to the tenants or are actually paid by the operator themselves. So okay, so the steps, so the data steps. So you need to if you're using online data, you need to scrape it. So for that, that's where the introductory part, Python, comes in. So Python or other scripting languages are really good at, you know, kind of parsing HTML online. So you can, you know, get the document model of every single resource out there, short of all the, you know, contractual obligations that you have for using that resource. So that's, again, like not for me to determine because I don't know the answer either way, by the way. So that's, but if you do scrape the data publicly online, or you purchase vendor data and the rest of the rental listings data, then you need to perform some kind of automated modeling on top of it, or like spreadsheet modeling, etc., and then produce some readable summary. So those are the data steps. The modeling steps, we compute estimated value add, NOI increase, which is the same as property value increase. So the whole goal here, this is not like, let's say, like to be like a technical presentation where, let's say, I don't care about the result. Like the result that I care about is just, okay, can I have a building where you raise the appraisal 30%, 40%, something like this. So that, and so get an estimated value add for each property, or rank those properties within target markets or across markets, and then get a final vector ranking to serve as a predictor of future rankings of actual value add. So those are the steps. So data sourcing. So again, the scraping part. So here you will see like some of the snips of my Python script. So generally, with most resources online, you need to perform a search. Again, don't do this for commercial purposes. This is for educational purposes only. So here you need to like perform a search just like a user would. So typically it may involve like query parameters in the URL. If that is how they structured it. So you may need to have like a template, like the one to the lower right that I have, where you have essentially all the input parameters that you can search by. And you are, okay, then you now have like a flexible system where you can search by, okay, state, county, city, like minimum, maximum rent. You can put different filters basically. So that's going to simulate like the same search that you would do in those fields, like kind of like filter fields on their respective online resource. And it's really quite consistent, this part, across different resources. And yeah, so you need to perform a search that kind of, you need a function to create a URL, just like broad steps. It can vary dependent on your kind of like your style, but you need to create a function that generates the URL, the search URL, so to say, and then you need to put in some scripting to extract from the HTML of that page. So that can be done via Python, can be done by other languages, if you will. And some of the syntax that kind of picks up the HTML is called expat, for those of you who are more technical. If you hate coding, you don't need to worry about it too much. You can use like different tools, no scrape tools. I'm gonna, if you reach to me after this lecture, I can link you to some. Like there's certain tools that can basically like, you use their software and they can like set up the whole process for you in without coding. So they're like kind of no code systems. Yeah, but generally you need to like have a function that creates a URL, then a function that scrapes out all the search URLs that are going to show up. Like here to the right, you get all the apartment communities, let's say hundreds of them. It's going to like collect all those, like kind of move through the pagination, collect all the URLs and that. So that's kind of like first step, just giving a high overview of scraping. And then you need to extract, once you have those 500, let's say, pages, you need to extract all their contents. So their contents are based on the elements HTML, and then kind of collect them into a table. And you may need to perform like multiple different searches and combine those. So those are like some of the, like some of the functions here. So like scrape page would actually go to every single page and, okay, access the HTML document and kind of hierarchically and kind of like be able to pick the contents of different elements. And again, this is just for like an introduction. It's not the goal of the model is the goal of this lecture, but just for introduction to give you a sense. So that's the scraping process. So at the end of this, what you're gonna have is you went through the URLs of the pages, and you're gonna have a big table like this, except instead of having here like 6 rows, it's maybe gonna have like hundreds or thousands, whatever. And then it's gonna have like different fields. So it's going to extract like all the information that is there. which is going to have like the rent levels for different unit sizes, like property descriptions, square feet, apartment counts, etc. And you have also like some of those extra income fields like pet fees, pet deposits, and like application fees, stuff like that. Just like all the information that is dependent on your rental listing source. But again, the concept is really to use the rental listing source and use it to derive insights. Okay, now the property analytics side. So again, this kind of on some of the technical parts are here. So what I did with my model, just as an example, so I pick data on all apartment communities. So I go about computing the building cost. So for the building cost, as you know, like the usual determinant is year built. So I kind of use a combined year built with year renovated. And let's say if it's renovated within a given range, kind of up the building cost by a notch, maybe something like that. So that's for building costs. It's like useful for renovation estimates, for example. And then I use input parameters for example, for utilities like rental listings. They give you an insight into what utilities are included, and just this simple information of what utilities are included can give you some potential to predict like value add on the utility component. So you can, but to do that, you need weights, kind of like you need, okay, what are the weights of, and these are very arbitrary, again, like don't hold me onto those, but these are like some weights that I kind of gauged within a given market of what like different utilities would be relative to each other. And then those utilities may fall in different categories. So some maybe once you purchase the property, you can maybe entirely remove. Let's say you paying for cable expense or something, maybe you can remove that, but others you can only reduce. So kind of like categorizing along like that, having the weights to that. And then you may be able for different fees, for example, like let's say pet fees, they might fall in different subcategories. So you want to kind of classify your data types and be able to kind of get the data more efficiently across those data types. So that's one thing. From there,
Stefan, there are a couple of questions in the chat. Do you mind me interrupting here?
Yeah, actually, I don't see them when I share my screen anymore.
Yeah, that's what I was thinking. You have a couple of questions here. The first question is from Bobby Wills. Can you speak about visualization library in Python and R versus Tableau or other visualization tools?
Sorry, can you repeat the first part? Can you repeat the first part, Konstantin?
Yeah, can you speak about visualization libraries in Python and R?
No, to be honest, no. I'm not super visualization. Yeah, I mean, like I know Tableau is super popular and super used. R, I don't know. I think R is generally on a decline in a way. Like I don't know. Some people like it. Obviously, I don't know what advantages it could have. I think Python is generally preferred in my opinion, but in terms of visualization libraries, yeah, I'm not like overly experienced. I can give you a few names like after the lecture. I know like some that I don't know my colleagues previously used to like, etc. But I'm not overly visualization honestly oriented.
There's a question from Nelson. How and at what level do I start to utilize this? And there's a follow-up question from Nelson again. What does the final product look like? And how do you integrate this into a broker conversion?
And by the way, and Konstantin, thank you. And integrating that into a broker conversation. So how does this?
Okay, I see. I kind of see maybe your question, Nelson. So for example, yeah. So how can you use it? So if you can purchase, let's say, reonomy data, for example, right? Which is what many people do in the multifamily space. Like they purchase reonomy data. Okay, from there you would have all the properties within a given market. Let's say it's Austin, Texas. So you have all those, and you have like the owner information. From there, you're going to have to still get some kind of insight into their financials, which again, the approach here is rental listings. How are you going to get the rental listings? Maybe there are vendors who provide it. Like here for this, again, like I said, educational purposes, apartments.com is definitely the biggest resource for that. I think it can be bigger than CoStar as far as in this regard. If you want to get data like from apartments.com, let's say, it's tricky, especially for commercial purposes. Like you can use it kind of, and maybe like me, like make your disclosures and stuff like this, and like use it kind of educationally just as a model. Now for commercial purposes, it would be tricky. But if you do want to like kind of, play around with the data, you need to get to like a no-code scraping tool. So there is, I forget like the names. I know like a few. There is like Octoparse is one. I think it's called Octoparse. That is a very good one. So it's just a tool, and they're going to kind of, you just like do like a small setup maybe at the beginning, and they would kind of do the process for you. It's again semi-technical. It's not so easy getting data online, but let's say you purchase vendor data from Reonomy, and then you're going to have to find a vendor for rental listings. That's going to be the other way. Once you have this data, you're just going to look at what you have available and like make a spreadsheet and try to model. The goal here is to model, if we have a market like Austin, Texas, for example, to get there, and it has, let's say, 100 buildings. To get which buildings have rents that are under market, which relative to the broad market, which buildings have pet fees, let's say, that they're not charging and maybe others are charging and stuff like that in the other income plans, which buildings have more potential relative to their utilities, kind of utilizing their utility expense. So that's kind of the goal. And then combining all those pieces algebraically, and okay, you arrive at how much you're raising the property value. So that's the goal. And then you're looking at, okay, you have those buildings at the top of your list. In Austin, Texas, they're going to have, the most, they have the most undervalued rents maybe. And then there can be different reasons. It could be, okay, maybe they're not in the same condition, and it's not easy to model, of course.
So Stefan, what you're saying is, and I'm not even a quarter as smart as you are, okay? Not even an eighth. I mean, I just can't get a small fraction. Thank you. So what I would do is I would kind of look at a funnel. I'd be scraping all this stuff, right? And then at the end, I have a target list of properties. Let's say there's 1,000 apartment complexes or 1,000 buildings.
Yep.
But then I would have my list of my 50 that I want out of the 1,000.
Yep, exactly.
Okay.
You have, exactly like you said, you will have all of the apartment complexes analyzed, just like Reonomy gives you the feed of all of those apartment complexes. Now you would know, okay, maybe which are the good ones. So you would that's kind of the goal. Okay, you have the list, but which ones to focus on. And then you can say, okay, there's so few, you can just send direct mail to all of them either way. Right? But now but it's different. It's still a step ahead to have this kind of intelligence, because maybe that's your local market.
Right.
Now, once you identify those 5 buildings and you kind of focus your mind on them, you can maybe be following up with them in person even, or in whichever way. It's like, it's kind of knowledge. Maybe you're going to follow up with them like over the next few years. So
right.
Okay, that's a building that has its rents below market, that has, some of the other income components are not utilized, and, expenses and stuff like that. So that's kind of the goal. And it's a very simple preliminary analysis, really. It's not going to be accurate. Like, okay, if you get your income expense sheet for an exact property, okay, just look at it and it's super precise. But you want to kind of make a predictive thing and like get like to the best ones, so potentially on a preliminary basis. And also this way you can do it at scale, because this way now you can get this data for many different, let's say here you will see at the end, like I have about 104 cities. So you can kind of, okay, get it across many different cities, and maybe you can change your direct marketing campaign. For example, instead of sending like what, multi-family indicators do, they pick 2 markets or 5 markets, right? And they kind of are sending their direct mail constantly there. And I get it, because real estate is a physical asset. It's not subject to, it's hard to do it in a data way. But you can also like maybe be less, be more spread out, and be targeting like just the best buildings. And you're not even like, you can just target like the top 10 in each market or something like that. Potentially, if you have some basis to understand like the market side, maybe, then that's definitely doable. So okay, yeah. So from here, then you have, yeah. So So one thing just to say, like when let's say finding properties that are undervalued. So you need the way, for example, and again, this is just an example with apartments.com. It's not about apartments.com. Just you can use a different source, but this is just an example. So here you would be able to pick neighborhoods, and for those neighborhoods, you would aggregate like different rent levels, square feet, bathrooms, and you would also aggregate what fees in terms of one-time fees, administrative application, pet fees, and other fees, and what recurrent fees in terms of parking, storage, and other different operators are charging. And once you have this aggregate information for the immediate market, and this is actually here on a neighborhood basis, it's not even it's not like the broad city or something, it's your exact neighborhood. It's exactly what you want, basically. So you get like this insight into, okay, where rent levels and other income and, other income information is in your immediate neighborhood. So once you have that, you kind of, at least that's just my model. So again, like here, like I compute units availability. So if you have rental listings, they kind of show you which units are vacant. And here, insight into that I got from my friend Konstantin, who is on this call. So he actually kind of came up with the idea, okay, let's look at the rental listing. And that was originally his idea. Okay, so it's let's look at the listing and let's look at to try to find which ones are let's say maybe not precisely a deal, but which ones have a value add potential. Let's see where their rents are relative to the immediate market. So all that this is doing it in an automated fashion and kind of incorporating all those other components of utilities and other income, etc. But you can look into occupancy, get a little bit of glimpse. There are some communities that they may show like many available units. So that's the only information you have. So that's the only thing you use to estimate occupancy, like the units that are currently listed on the market is vacant. From there, you can compute like unit weights, like how many one bedrooms, like this from 100 units, this community has 20 one bedrooms, 50 two bedrooms, and let's say 33 bedrooms, something like that. So you can get the unit mix, you can get what the current rents are, you can compute what the potential rents are. So to compute what the potential rents are, you need to use the market information that I showed on the previous slide, and kind of like you have where the market is, and you're looking at your properties. You're looking at your properties specifications in terms of like square feet for different unit sizes and bathroom counts for the different unit sizes, and you kind of scale. You use kind of like a diminishing return scaling function to scale up or down to the level of to get like where the market is saying for an equivalent kind of apples to apples unit that it should be. And then maybe for potential other income, like all those extra fees, you can compute, again, you have the averages for the immediate neighborhood, and you may get like, maybe you can improve 10%, or you can use another assumption or something like that. But again, like getting this kind of insight into, for example, what different operators are charging for their application fees, etc., and do it at scale, it's I think, mainly doable with listings, rental listings data. So you get this information, occupancy percentages as well. And yes, so you compute other income, current and potential other income, and the increase that you can get if you purchase this building, and you compute the current rents and potential rents and the increase that you can get if you purchase this building. And this is a very preliminary, of course, analysis, but it still gives you some perspective into the potential that the building has. And then the final computation is for after, let's call it after improvement value. So after improvement value, so after raising the rents to market, and that can have varying expenses that you incur in order to do that. But here is just, okay, where the ceiling is, like what is the potential. So getting like, what is your value add percentage? So that's what we're trying to compute here. So to do that, you need to make a little bit of kind of like, derive it kind of algebraically, where you're missing some of the pieces to that like kind of algebra. So you need, let's say, you need to know what the aggregate expense ratio is. And then, for example, if you have an insight into the utilities, because you know which utilities are included, which are not, you know that for different categories, some may potentially be removed or some may be only reduced. So you want to model this. So to model this, you need to based on utilities which are currently paid by the operator on this community, based on its rental listings information. You want to get a sense of, okay, maybe utilities are a quarter of the total expense broadly, it's an assumption. Maybe the total expense is generally, I think the rule of thumb assumption for multifamily is like a 50% expense ratio, okay? And it's just a simple model. But then once you get your utility categories, then you will receive like maybe that utilities are about 9% of the aggregate expense or something like that based on what utilities are currently being built. And then what will be your improvement? And then what is algebraically the contribution of this improvement to the final value of the property? So that's kind of the idea here. And the calculation is done like here, it's just like the calculation below. It's just done on a unitized weighted average basis for the property's estimated unit mix. And so the both like current and potential gross operating income are unitized. So they're unitized, so you're looking at like per apartment, let's say, of different sizes in this case, and they're a function of the current and potential weighted average rent, other income, and occupancy as well. So you're trying to reflect as many factors as possible in the final value add percentage, and utilities and other expenses are a function of gross operating income, expense ratio, and calculated weight of utilities expense within the total expense. And then the potential utilities and other expenses are a function of the occupancy change, let's say, and calculated utility improvement percentage. So it's just the spirit is to get like the final, like factor as many elements you have publicly available. It's like publicly available data or vendor provided data that can give you an insight into a calculation to derive like the final value add percentage. So that's actually the model. So here's an output, the output actually of it. So the output like gives, for example, that's for 104 US cities, preliminary analysis, and this has about 32,000 commercial multifamily properties in 104 cities. So it's going to show like the building cost, the unit mix. Let's say the third property here has like 27% of the units in the building are studios, and that's an estimated unit mix, and 44% are one bedroom, and 28% are two bedroom, and 2% of the units in this 321 unit property are three bedroom. And the property is built in 2016, and it is where they have the class, is class A respectively, and it has, you know, certain utilities that are being paid, you know, by either the landlord or tenant, which let's say trash and other, etc. And so this is, so this like gives you kind of like some of the final feed, and then you have like the current, recurrent and one-time other income. So for example, let's say you can see what income your property has. So for example, it has like an application fee of $75, or it's a one-time fee, and then maybe it has like a pet fee of $45 a month, recurrently every single month, recurrent obviously. And then it has a given occupancy, estimated occupancy of 87% for that building. And you know, those are its current rents, like very high levels apparently for this particular building. And then the potential rents based on the surrounding market. So in the end, what you want to arrive is, again, like here, that was my model. I wanted to really model, just to clarify, here you're going to see like AAV percentage that are kind of astronomical, right? Super high. Okay, so that was just kind of my model. I wanted to model properties based on its other income, like that are really missing their kind of pet fees and stuff like that, and like kind of to see like which have it the most. And then this is of course wrong, you know, it kind of is a actual value that you're going to get. But what I'm after is this vector of numbers to correlate with the best ones, kind of the ranking to be correct. If you take the other income component, which is like really opportunistic and maybe really aggressive in a modeling sense, to assume that, okay, we can charge all those fees that, well, now you're charging zero. You know, if you take this component, then you can rely on what is much more hard evidence by your rent change percentage, which let's say for the first property is 14%. So you can rely on, okay, if you can raise the rents 14%, and that's your gross, and if you are able to do it for a property that is actually maybe in perfect condition, that maybe you don't need to renovate it. A 50% expense ratio, you raise the appraisal by double that, by 28%. So that's kind of like a more hard evidence value add. And then you have like some evidence into reducing the utilities, where let's say the sixth property here, you can kind of maybe get an improvement in utilities expense of 10% utilities contribution, I think, to the final value, and then some insight into other expenses as well. So that's so once you have this information, you can produce some summary analytics. So some summary analytics would look like that. So kind of getting for different markets, for different cities, what are your you know, like percentages of buildings in different unit size ranges. For different classes, A, B, C, and D, average utilities paid, average percentage occupancy, and you can look at the top tier in those markets. Okay, what are the rent change, like what are the value add elements that you can realize where there's the most rent, you know, you have found the most properties that have a rent improvement potential. Obviously, there's no market that is better because the market is just the market. You're looking for discrepancy relative to that. But the ones that have shown a higher potential for those 90th percentile top tier properties, and in other income space, in utility space, and in the final after improvement value space. And you can add like further statistics as well. So that's kind of how it works. So if you take like, for example, Atlanta, Georgia, so you're going to see, okay, there's like 201. So that's going to look a little bit like the Reonomy feed maybe, or I'm not sure, or others where you can have like, you have like 201 apartment communities between 100 and 250 units, and 261 that are even bigger, above 250 units, and then a few at the smaller size ranges have been, you know, and are in this specific data source. And most of the properties are Class A, and you know, stuff like that. And if you pull maybe the Northeast, maybe the percentage is going to be tilted towards the, you know, towards Class D respectively. And so you have that, and you have like some of the what occupancies have shown like in different markets, and you have the what kind of the top tier value improvement percentages for rent, other income, utilities, other expenses, and final after improvement value. So you can supplement if you are using your own data, like it's done in this this analysis here. You don't have then the owner information. If you are using Reonomy or Prospect Now vendors like that, you have the owner information, but if you are not, then you don't have it. So you might extract it yourself from county resources. So these are some Python functions that do that for given counties. It's kind of tedious, to be honest. I think it's definitely better to use a vendor. So in conclusion, validating the model. So, and really like, what is the goal of the model? So the goal of the model is not computing like super accurate percentages of after improvement value, which is going to be impossible. You don't have sufficient information. You have glimpses of information from rental listings that you're trying to use and derive the best predictor of the real situation that's going to be in the future. But the goal is to get a ranking vector of apartment communities by percentage value add expected to show the sufficient correlation with subsequent value add that's going to happen. And so again, like just like kind of like on the image on the side, okay, like at the end, like if you're in the correct direction, that's what you're trying to achieve. Challenge is how are you going to actually validate this afterwards? Now it's going to be difficult. You're going to have either get have the historical sales information. That's the better way and do it backwards. I don't have it myself. I don't have a subscription to CoStar. If you do have it, you can get that potentially, and kind of try to do it backwards, and then maybe access like some old versions of rental listings resources online, and like try to do it as if you had modeled it like a few years earlier, and then what actually happened afterwards. Other than that, it's challenging. You need to like collect like data prospectively and like be tracking it like a few years ahead. And you know, that's kind of the only way to validate it, or you know, in a kind of statistical way, and you're need to have like hundreds of them at least. So applications. So the model provides for preliminary analysis of a large volume of apartment communities at scale. So when I say a large volume is, for example, in the table that I showed at the end. So the full table has 32,000 apartment communities. So is this as accurate as getting an income expense sheet on a property off market that you send direct mail to, and okay, you got the income expense and you now get a glimpse into it? No, it's not. But is it 32,000 versus 1? Yes, so that's the goal. So it's a preliminary predictive model. So of a large number of apartment communities at scale. So that's the goal. So it allows to rank properties within specific markets as well as across markets, better informing direct marketing campaigns and overall investor focus. So better informing direct marketing campaigns, for example, by, as we had a discussion previously, picking the top properties within given markets. So instead of now being focused on just direct marketing to a single city or neighborhood or market, you may instead, and it's not necessarily preferable, but you may instead take the approach to, okay, take the top 20 or something in different markets and maybe just direct market to those. If you're flexible with the market analysis side. So it's an easy study on, in theory, unlimited markets inventories, and a preliminary scalable automated look at buildings' income expense potentials. So again, like legal guidance for any data sourcing, even if you purchase the data, use legal guidance, because maybe you're not permitted to manipulate it or use it in a certain way or in a commercial setting. So that's very important. And like what I'm presenting here, it's just modeling and educational purpose. It's not encouraging to use any particular resource. So for more information, so I have a custom course on data-driven investing, which is a 5-session program. But you can book at envyanalytics.com, which is my data LLC, envyanalytics.com mentorship. And I also issue a report on overvalued markets, envyanalytics.com get sample report. And this is my YouTube channel. I also posted it in the chat. So with that, we can open for questions if you guys have. Yeah, Nelson, you good?
Yeah, you know, Stefan, I tell you, whenever you do a presentation, I feel like I'm in a sprint and I end with my tongue hanging out. So this is impressive to do.
I'm gonna give you a shorter. We'll talk about it.
This is very impressive to be able to find, because the question turns into, especially on the multifamily side, we live in a big country. Each state has at least 2 or 3 cities, you know, so that by itself, that's already 103, 150. Some have more than that. And it's always the needle in the haystack.
That's true. Yeah, that's true. I mean, and it's actually very expensive to be getting lots of data, and it's not easy. I mean, it's kind of expensive either in terms of labor or actual, you know, expenses that you commit. So it's, I think it's, I agree with that. Yeah, it's not easy. I mean, there's a computational expense to it, and
yeah, I mean, the way I see it is there's 2 ways or 3 ways really. One way is develop strong broker relationships, right? And then the broker is the one that knows. That's one way. The other way is direct mail and somehow reaching out directly to the owners. And then this is the 3rd way.
Well, I think this is more like, let's say direct mail, it's your point, and brokers they're the main. I think this is more like, you can use, you can say it's the 3rd way, yeah, or just to supplement even your direct mail and kind of have your direct mail have more intelligence behind your direct mail and be able to pick, I think one second, I think I'm going to be able to see the chat now. I finally figured it out. But yeah, just be able to pick, you know, intelligently maybe which properties to target. Yeah, I agree. It's kind of the other way. I mean, because in the first 2, you pick your markets like in a super focused way, and it's not bad because I mean, you know them. It's just you're constrained. Like I'm not super comfortable myself with this the kind of approach where I need to focus on a single thing, and like I don't know. It just maybe it's just not for me in this sense. Like I feel like I'm missing out. I don't know how to say. So I want to have like more potential, and like, I just feel it's more scalable otherwise. It's just scalability is the issue. It's just, if you look at like real estate investment management, a lot of the approach is they don't scale, right? And there are reasons why they don't scale, because it's a real estate is a physical asset, so it's hard to scale. And it's like, there's some people that I know that there was a guy who spoke actually at my webinar a while ago, and he spoke a little bit about trying to scale small multifamily investing, like 2 to 4 units. And we've had this discussion, and it's very challenging, like how do you do it? Because you have obviously like properties of, like very different physical characteristics, and all the property and that is difficult to handle. And similarly, if you're picking markets, let's say, and even like off market, which is the topic here, like off market apartment communities, you don't know them well. You need to see them in person, and it's true, and you need to know markets well, and that's the reason for that. And it just makes sense. But again, this is, you can still use a targeted approach, like, and have your single market, and this would actually greatly help you for that. Maybe then it will be even easier for you, because now you would know from those 200 communities in your town, you would kind of know, okay, maybe these are the top ones. Let's kind of focus on them. I'm gonna following up with, with my direct mail campaigns all the time. Let's say, like, I know that Midtown Commons or whichever community, that's like a really good one. That's just filtered super high. That's something like that, It's filtered super high. So I'm gonna literally kind of keep it on the back of my head, and it just becomes even easier then, because it's just a few, and kind of keep on the back of your head and remember, now this is a great one. So keep following up with it for a few years. It's just, again, like, this is not to say, it's not, I don't think it's a substitute. I think it's more like, how else do you do it? Like think about it. Like, if you want to, it's just like with Konstantin, and he's here on the call, like I see him now. So we had like this discussion, like, if you want to see, like, let's say, let me try to open like a slide. If you want to see like, okay, let's say like here we have at the top, we have the Mark, Linwood Park, and like different communities. And how are we gonna, if I do it manually, how am I going to achieve, like, to judge, and they're all off market, how am I going to achieve it? And that's pretty much what this is. Not trying to be something, there is nothing, I would say, like, excessive that is trying to do it. Just trying to do, okay, how do you do it in a, the same thing that a human would do in terms of getting an insight into those properties. What are you going to do? You're going to go online, you're going to look at what the rent level, try to see what the rent levels are in those properties. That's what people do, they go to apartments.com, they look at what the rent levels are. But that's tedious. It's just not easy. You're not able to process it so much and so well. And it just, you're going to have to open so many of those, and like, this is going to take thousands of, that's the goal, just to automate and scale, and get, in addition, it's going to have more into it. It's going to build in those other income expenses, etc. And you cannot just, sometimes you can use your intuition, but you cannot intuitively just derive like the final number. Sometimes your intuition is wrong. You're intuitively thinking this property, because it has undervalued rents, it has the best value add potential, but it could turn out that when you put in other factors, maybe it's not. Maybe there's the better one, or something like this. So, it's just like, really, what would you do as a person who is trying to process off-market multifamily data? How are you going to do it? You have your Reonomy feed. You will look at, the full list. Maybe you just send direct mail to them, and then you will get the ones that you get back, you just study them one by one. I think that's what's happening. That's kind of where the industry is at now. It just, this is one idea to kind of scale it, and this is just what I did for myself as kind of one approach. You can build a better model, I'm sure, and especially if you have better sources. Maybe there is like a vendor rental listings data that's really high quality, that gives you even more insights into the income expense sheets of different properties. It's just work with whichever information is available, and try to combine it and arrive with as correct answer as possible. Like, that's the goal. And yeah, so we have a couple of, I think already going over time, but we have a couple of questions.
Thank you, Stefan.
Yeah, thanks, Nelson.
And Konstantin too.
So yeah, so Bobby is asking in the chat, so is there information you will keep from scraping versus accessing the information via their API? Again, scraping, I think, yeah, you don't have the answer if it's entirely wrong to do it always. I think you do need to consult an attorney. There may be cases in which it's acceptable, and also obviously varies by every single resource. So it's like super complicated. So I cannot give any answer, I think, in either direction. Now, obviously, if it's a company's API, means you can access the data. The fact that you access that data, again, doesn't mean you can use it for intelligence purposes, because they can say you can access it, but we don't want you to use it intelligently or too much or in a commercial setting. So that's also possible. So it doesn't mean in that scenario that you're fully protected either. I'm not aware of APIs for rental listings data. If you do find one, let me know. So yeah, that could be great. So yeah, API, that's an application programming interface. So where you would, for example, Zillow. So Zillow, if you want to get the Zestimate for different properties, you can kind of have in your access their API, and you can just put in the address of the property, let's say, and they give you what the Zestimate is, and or what like other information on the property is. And it's pretty limited. It only gives you like a few fields specifically there, but that's what it is. And yeah, that kind of tells you that, okay, they're in agreement for you to use that data to the extent that they have displayed it there. So that's definitely a step ahead. But again, it doesn't mean you will fully, your usage could go beyond that, especially if you're optimistic. So that you're always, I think, you probably always need an attorney to actually advise. And then, yeah. Okay, yeah, Charles, so you're asking, is it a product? There's no product, I'm not selling any product. Yeah, this is more, how to say, it's not a product presentation, and it's also not a how to build your own. It's more like, it kind of gives you, if you do want to build your own, yeah, it kind of actually shows you that. But I understand that most people maybe kind of, they don't want to, or it's too much like they don't like coding. So in that sense, so I would say it's more, not how to build your own, but just look at the conceptual approach and the methodology and the fact that you can scale this and the fact that it's doable and the fact that today with what I shared like at the beginning, if you have like this framework, their internet technologies, that you can access so much data online, that just gives you like more analytical potential as an investor. So it's more what I'm trying to do with this lecture, is just give like this kind of mindset shift and methodology presentation, and not where, okay, you have like some of those scripts and I kind of show how I do it. I try to be complete, and that's why it gets maybe a little bit overloaded. But it's not so much how to build it. It's more like, if you know the approach, then you can find different ways, maybe better ways yourself, where you purchase vendor data and then you can just do your study in Excel. If you have the vendor data and you have on the properties and you have the rental listings from somewhere, and I'm just not aware of vendors who do it, that's possible. You can then just do your study in Excel, but the goal is, okay, have some kind of off-market analysis in your, if you're an active investor, meaning in your, I know you do lots of passive investments, right, Charles, as far as I remember.
Hey, Stefan.
Yeah.
So on NV Analytics for the single state package, does it update itself, or how does that work? Just maybe, if you follow like this thing that gets sample report, you can, I'm going to get your, I guess, your contact information, and we can take it from there. Yeah, it's just the single state is just like, what's the single state? The single state is at state level, and let's say if it has 100 counties in that state, it's going to give you like a set of reports. So that's what it is. So it's going to be like a set of reports, but has nothing to do with what we're discussing here today. That one is market analytics, and that one is what I thought is value add in the industry personally, to have a valuation metrics, which is to
show if different markets are overvalued or not in a way that has predictive power. So my value kind of there was that I didn't even invent it. I just looked at they calibrated a model that is predictive of downturns post to peak. So my value was okay, sure, it actually works easy because real estate is fundamental and kind of simple, relatively simple to predict at the downside risks perspective.
Stefan, excuse me, can you post the 2 links in the chat? The custom course on data-driven investing, and then the sample report on overvalued real estate markets. Can you post those in the chat?
Yes, sure.
Thank you, Stefan. I'm sure there'll be some people interested or at least reading up on it.
Yeah, I keep struggling to get to the chat somehow. Okay, do this. Yeah, sure. So, I mean, it's just this way. Yeah, if you guys have any other questions, let me know. Yeah. Yeah, the first part, I've been talking to some people basically who want to do multifamily syndication. So the mentorship part is really, if you guys are interested in data-driven principles, they kind of like guide you through my processes and like all the tools that I have built. I have a typo at the URL. So the URL is this. Yeah, so it's really just showing like data-driven processes that I have, and like kind of like this perspective to doing your own investment. Just guiding you through my scripts and processes that I use on my end in my own investing practice. And yes, so okay, yeah. So if you guys have other questions, I just went through the chat. If you guys have other questions, let me know. And before we wrap up, yeah, do you maybe last couple of questions?
This is good. I'm still processing the information. No more questions for me.
Mm-hmm. Yeah, if you have any questions afterwards, let me know. You know, you can reach out. You have my contact information. So yeah, you guys can reach me on LinkedIn as well. So Stefan Tsvetkov on LinkedIn, or also YouTube. Like we post lots of content on YouTube. So. So again, it's just as a summary, just that's applicable to large apartment communities. You can use it for anything above 5 units. So yeah, if you make a better model as well, let me know. I want to use that myself. So.
Stefan, thank you very much. This is very informative. And it definitely helps searching for the needle in the haystack.
Yep. Well, thanks for joining. And yeah, thanks to everyone else as well. If you have any questions, do reach out, or yeah, go to nvanalytics.com and those parts, or just send me a message on LinkedIn. Thank you guys. Have a good evening. Bye.
You too, Stefan. Thank you.